rubber prices. So if there's good positive figures coming out from China, then there was a possibility that speculative money flows into rubber market. But that was not the case. At the end of the last year, there was both manufacturing PMI and non-manufacturing PMI in China. There was a slight improvement in that figures, but that really didn't translate into price movement in rubber market. The other factor, the rubber stock numbers. Well, in Japan, and in October last year, there was about 5,000 tons of stock in Japan. This was increased by double, and in December last year, the figure went up to 10,000 tons as a rubber stock in Japan. But this again didn't had any effect on price of rubber. The price can go down if the stock of rubber increased, but that didn't happen. Maybe part of the reason is that we are entering into the wintering period, where the rubber production is going down. So those two factors offset each other. So right now, some experts are telling us that we are in a vicious cycle where people cannot have any driving factor for the price of rubber to either go up or go down. So people just stay away when they see low volatility, and so those kind of vicious cycle is there. But having said that, there's other views that the price of rubber cannot go. Maybe it's stable, but cannot go down. When we think about the economic recovery and price of equities going up, there's a chance that excessive liquidity will be increased, and there will be more speculative money going to the rubber market as well. And there's expectation for the real economy to recover. Another part of the reason. And when we're talking about Japanese economy, we think that we are right now in a time of the deflation is finally we are overcoming that situation. So considering these kinds of factors, in addition with the decision by the ITRC, that's Thailand, Malaysia, Indonesia government, to restrict the number of the export to a certain level, those kind of factors maybe, there's a chance that there will be a gradual increase in the rubber market. So I think, that's the kind of a view that we're seeing the rubber.
Great. Thank you very much, Mr. Seiki. I think that will be really important to a lot of our audience here, since rubber is a very important commodity in Japan. So just to clarify, if I understand you correctly, there's a lot of factors that investors should look at, but one that you pointed out was the role of government policy, and perhaps you could provide a little bit more color on are there any more government policy changes that you might see in the horizon, or maybe some institutional activity that might further impact the price of this commodity?
I think there will be no more additional maybe governmental action toward that, but I might just want to add one opinion about the ITRC's decision. That is the restriction on the size of the export. So not the volume of the production. So unlike what OPEC has done with the crude oil, the reduction of the production of the crude oil, it is just the decreased amount of export by these three governments. So when their agreement expires, maybe in April, there's a great chance that the stockpile of rubber can flow into the market, which can have a negative impact on rubber market, which was the case last time such agreement was made. So maybe you should look after those kind of maybe risk associated with the governmental action.
Great, thank you very much, Mr. Seiki. One question that investors have been asking is, obviously in this region is a huge rubber growing region. Palm oil has been gaining prominence as well as another crop that grows in similar climates and conditions to rubber. Perhaps our panelists from Malaysia, Mr. Kenneth Chan, can provide a little bit of color on why do traders right now who primarily or exclusively trade rubber should consider palm oil as well.
All right. The rubber market and the palm oil markets on the physical space is two different markets, right? So normally in terms of users of futures contracts, such as like palm oil, they focus on the physical players using it for hedging. Then you have the traders coming in to trade it to have a view, or maybe merely just to speculate or to make money out of the movement of the commodity prices, right? So in terms of the physical market for the palm oil, Malaysia, Indonesia largely are the biggest producers of palm oil. Malaysia is number 2, I think roughly about 19 million metric ton, of a global production of 65 million, and secondly goes to Indonesia. In Thailand, I believe, I think the production is roughly, it's quite small, it's about 5% of global production. But these 5% of companies in Thailand may use our futures contract as a hedging tool, right? That's one. And more importantly is that because our contract is denominated in ringgit, then there's always an FX component involved, right? So as I mentioned earlier, that investment in Malaysia, let's say in the equity sides or in the bond market, you can use them as an underlying to hedge, right? But before this, you can't use derivative as an underlying for FX hedging. You cannot, right? But as of last December, right, we spoke to Bank Negara to facilitate better hedging and better liberalization of the FX. And they have actually agreed, and it's been announced that foreign investors now, when they trade into our palm oil market using our futures on a palm oil FCPO, they can use the FCPO contract as an underlying to hedge the FX. This is a very, very important point for foreign investors, right? Because they're coming into our market and they don't need to worry about the FX swing, right? So secondly, on the point of whether current rubber traders, or let's say the retail investors trading rubber, can consider palm oil as another avenue to trade, right? So when it comes to trading, of course, in the commodity space, if you're trading rubber, you can always expand your commodity basket and to include palm oil. And as a trader, what do you look for? You look for liquidity, which we have it, right? Averagely, we trade about 50,000 contracts a day, up to maybe a high of on a good day of nearly about 100,000 contracts a day. There's liquidity. There is a wide, diverse range of players supporting the liquidity, from the physical side to the speculators to the arbitrageurs and such. So, the most important thing for traders is on liquidity and whether there is price movement in the commodity space, right? So there is price movement. Of course, there's price movement on the palm oil contract. Last year, I think it traded about 600 to 700 points on low of 2004 to the high of 3001. And intraday basis, there are a lot of we have seen a lot of traders coming in to scalp the market. No? There's a lot of opportunities for traders to make money in the market. We have seen now with the incumbent growth of fintech, right? There's a lot of companies and prop shops who set up algo trading to trade on our markets, and we've seen that coming in from Singapore, from Hong Kong, and such. So I believe that as a trader who trades rubber, you can always include palm oil as one of your another means of instrument to trade and for a view of on the commodity space. And I think there's good opportunity for you to consider that.
Great. Thank you very much, Mr. Kenneth Chan. Now, on the same topic of commodities, when we speak of commodities in Thailand, we can't escape from gold. Perhaps our panelists from Dubai would like to give some color in terms of, since I understand from your presentation earlier that Dubai has a unique rupee-denominated gold product. So not only do you get exposure to gold, you also get exposure to India. But more specifically on the topic of gold and also maybe also oil, since you're from the region, perhaps you could provide your views on the recent recovery in the commodity prices. Do you think this recovery is sustainable, or what kind of factors should investors look at? Mr. Ming?
Thanks. I think let me just touch a bit on the gold product side. We have a couple of gold products, starting with the US dollar denominated gold futures contract, which is our first contract for the exchange. Then we have the Indian gold contract, which is denominated in US dollar. We have the Shanghai gold futures contract, which is denominated at using the renminbi. CNH contract, CNH denomination. And lastly, we have a spot gold contract, which is physical delivered. Now, I just want to highlight certain points here. Last couple of years, there were fluctuations on the gold market, hovering around close to 1100 all the way to 1300 plus, trying to hit to the 1400 mark, came down. But there were some events that happened in general for the region. One of the events that took place was the India tax on gold, which happened last year. And that has a big impact to the demand in the India gold market, where Dubai were affected. Just imagine this, 1,200 tons of gold to be imported into Dubai has suddenly become undeclared or whatever. It has plunged to close to about 400-500 tons. The price has gone down. So what actually created out of this is an opportunity, or the opportunity to do movement of gold. I think 2016 we spoke about that. 2017 we spoke about that as well. Even I visited Bangkok to a few gold traders on the opportunity where Dubai price has gone very deep discount, where the opportunity is they can actually buy in Dubai, ship it to Hong Kong or Switzerland or wherever, and you still can make, after taking out of the transportation costs, you still can make money out of it. So there were opportunity. Now in 2018, that has gone. There are other opportunities occurring. One of it is the Shanghai gold contract that we saw. There is a premium to the international US dollar gold product. So there are opportunity for us to look at for the participants. Now, in terms of the patterns of the participants, it's also very unique in Dubai, because it's coming from everywhere around the world, especially in this region for the Middle Eastern clients, for the Indian subcontinent clients. Every bat counts. So the arbitrage is quite actively looked at. They look at different markets, they look at different economics, different effects. As a result, when we launch products, we always look at, are there any money to be made in this contract? When this vanish, what are the products that they can look at? So these are some of the values that we create to the market to have it for the participants to look at, hey, if copper is the flavor of the year and it's gone, what are the flavors that they can look at?
Yep, thank you very much, Mr. Meng, for giving us an overview of not just on the commodities, but one of the major factors which affects gold, which is India. Just on the same topic, I'd like to return to our panelists from CME. As we know, NYMEX is the benchmark for oil, while COMEX gold continues to be the largest liquidity pool. So perhaps, is there anything that you'd like to add on in terms of factors that investors and traders should be looking at in terms of these two global products?
Thank you. In terms of the WTI contract that's traded at NYMEX, it is rapidly becoming a global benchmark in crude oil prices, and we also have a supporting suite of supporting refined products in crude oil as well. Not just crude, but also gasoline and other refined products, the crack spread on crude and so forth, all actively traded through that same NYMEX complex. The COMEX and the other metals that are available through CME is an enormous part of our business, and it's also one of our faster growing businesses, and that's in large part to the increase of activity from the Asian Pacific region. COMEX gold representing probably the flagship product in that suite, but also copper, lead, silver, and non-ferrous metals and industrial metals as well. The fact that they are all traded on Globex, which is available 23 hours a day, is the main driver, but also because of the increase in true economic activity, in growth, primarily in this region for the raw materials, of copper being probably the most prominent, but also silver, palladium, platinum as well. So as long as Asia's growing and growing from an industrial base and production and construction base, I think it's reasonable to assume that there will be a floor in those precious and as well as industrial metal prices as well.
Thank you very much, Mr. David Gibbs. I just want to return on, as we know, China is far and away the largest voracious consumer of a lot of these commodities. I'd like to pose the next question, risks and uncertainties, to our panelists from Hong Kong regarding the Chinese economy. As we know, China is approaching a two-speed market, the old versus the new, with sectors such as industrials and big banks experiencing a little bit of a structural slowdown, while on the other hand, new consumer-oriented services, internet-driven companies are at the forefront of driving growth globally. Is new China's growth enough to counter the hard landing narrative of old China? Mr. McAvoy?
Thanks. Yeah, look, it's again another great question. I think when I think about China, I in some cases think about where the U.S. was in the mid 1900s, coming out of World War II, when they started to build their own network of roads and communities and exit ramps and shopping centers and so on and so forth, and it really fueled the development of Middle America. And you know, so I think in the case of China, that will continue, and I think that we're seeing that. And secondly, in terms of new economy, that's much the way the world has gone, and I think China is certainly leading at the forefront of that at an accelerated pace. So I would sense that it should continue.
Great. Thank you very much, Mr. McAvoy. Just on another large economy in Asia, in addition to China, is Japan. So Japan, like China, is also balancing two different factors. On one hand, its unemployment is at a 24-year low of 2.7%. But on the other hand, the average workforce is rapidly aging. Perhaps, Mr. Seiki, you could give us your opinion on how should investors view investing in Japan with these two polarizing factors. Mr. Seiki?
Yeah, actually, the Japanese economy, when we see the start of the 2018, we can say that the Japanese economy had a good start. The Nikkei reached 24,000 yen this Monday, which is the first time in 26 years. So there are several reasons for that, but I'm not going to touch upon every factors. But the BOJ's decision on maintaining its accommodative, qualitative, and quantitative easing program on hold had a lot to do with this. And what is worth noting is that this, price hike in Nikkei is not because of the depreciation of yen. Actually, yen is appreciating from the start of this year, and because we started with like 112, now it's 110. So even yen is getting stronger, the price of Nikkei is going up. So some experts are saying, there are, I think, major consensus is there that the Japanese economy has finally overcoming the aftermath of the collapse of the bubble. When we look at the job to application indicator, the figure is 1.56. And this figure is very important because at the peak of the bubble, this ratio was much, much lower than this. We have to go back to 1970s when Japan was experiencing high growth period. So right now, the employment situation is really improving in Japan. So there's, and I think when we look at the PE, price earning ratio, right now it's about 18. But the figure was 70 to 80 at the time of the bubble. So right now, the price level is really reasonable compared with the depth of the bubble. So some are saying that the price of Nikkei can go up as high as 30,000 yen. So I'm not really sure about that, but that's kind of a opinion is we can see from the expert. So yes, we are really maybe positive on outlook of the Japanese economy as a whole.
Great, thank you very much. To recap, if I understand you correctly, a lot of the growth which is driving Japan right now is coming from actual real structural reforms by the Abe government rather than just quantitative easing by Governor Kuroda. Is that correct?
Yes, I think so.
Great. And the devaluations of the Japanese market still makes it very attractive when looking at a historical perspective for investors. Is that right?
Thank you for that. Yes.
Great. Thank you very much. So I want to make sure I heard that correctly. Great. So from Japan, let's move on to another neighbor, which earlier you heard on, it's also an interesting investment opportunity. Korea. Lately, for better or for worse, we've been hearing about Korea in the context of the North Korean risk and uncertainty of a nuclearized Korean peninsula. Right. However, I believe that there's also a lot of positive stories coming up from Korea that might have been overshadowed by some of the negative press, such as greater cooperation with North Korea from the incoming Olympics and some of the real growth in the economy, as well as structural reforms in some of the chaebols in Korea as well. Would you like to touch upon that?
Yes, thank you. Now finally we are giving attention and interest topic is war. The North Korea threat has always existed in Korea for almost 70 years since outbreak the Korean War in 1950s. Let me ask you one question. How many of you have heard any news that we had military collision or war combat in Korea after 1950s? Okay, let's give you an answer. And you briefly touched this coming Winter Olympic Games, and I really want to see solid peace on Korean Peninsula throughout this coming Olympic Games. Historically, the impact of North Korea's missile launch and nuclear test on South Korea has been eased. This is a result of the market adapting to the repetition of the similar cases all the times. And this is also attributable to enhancing the physical strength of the Korean capital market with a growing correlation with global economy. Funny thing is, Korean capital market is fluctuate more when Mr. Trump tweet than North Koreans missile the fire the missile. This is a fact. So, but however, the North Korean threat is one of the biggest danger in Korea. So Korea Exchange always prepare for the stable market operation and retraining and exercising to protect the investors' asset regularly or irregularly with our government. So please, the worst case of scenario is not going to happen in Korea at this time. Okay? Thank you.
Great. Thank you very much, Mr. Lee, for clarifying that the worst case scenario will not happen in Korea. We heard it from an expert himself. Great. From Korea, I'd like to circle back to perhaps geographically one of the smaller countries in the region, but also a very important gateway. To our panelists in Singapore, I'd like to pose a questions on perhaps some of the products that our audience might not be as familiar with, but it's a very large part of your business. Currency futures. I understand that the Indonesian rupiah currency future is one of your most popular contracts. My question to you is, how does using currency futures such as this provide investors a way to access the growth story into markets such as Indonesia? Ms. Lilicha?
So currency futures are the most recent addition to our suite of products. So it's, for the longest time been looking at currencies, but, it was really difficult to break into the interbank market because that's where most of the currency derivatives were traded, interbank mainly. So it was with, regulatory shifts towards exchange listed products that we began to look a lot more closely into it, and we have started inroads. And we've had good success, in particular for the CNH, which is the offshore Chinese RMB, and also the Indian rupee contract. So these two are the main products that we've been able to gain more headway. Now the regional currencies have recently been introduced, but as they are new contracts, it takes time for those to take root, and we've been continually working towards building liquidity in those products. So when you look at all the currency exposures, I think everyone takes a view because currency is really an indicator of macro economic consensus, and that will give you a broad market exposure. So we've seen very good take-up, particularly because it's leveraged to a big extent because the margins tend to be low because the volatility isn't as high as some of the other asset classes. So, some of the margins for these products can be as low as less than 1% of the notional. So that's been one of the attractions. As I mentioned, the transaction cost is again very low. And that's, it's usually a fixed price on a per contract basis, and it can be, it's less than $1. So that's, again, another cost-efficient way to get access. Now, as mentioned by Gary, it's you can take a position on either side of the market. You can take a bearish view of it and sell, or you can take a bullish view of it and buy. So that's again another good mechanism that futures contracts deliver.
Great. Thank you very much, Ms. Chia, for the overview of currency futures. A quick question I would like to touch upon Mr. Lee's statement earlier that, now when Mr. Trump tweets, the markets, move. So I think having a wild card such as President Trump in the midst provides some much needed volatility in some ways to traders who are looking for that. But just touching on the question is regarding U.S. interest rates. Employment, perhaps point to further interest rate rises beyond the 3 signal in the December Fed meeting. How should we balance these uncertainties, with the current White House, which is seen in the U.S. economic recovery? Mr. Gibbs?
Thank you. There's a lot to look at and consider in terms of an interest rate outlook for U.S. dollar products, and CME is a great place to go to look for some of that, first of all, information, but also how to deal with the risks associated with it. In terms of the macroeconomic and central bank activities in the U.S., the economy looks anemic compared to the growth here in Southeast Asia, but we are seeing an increase in growth. The tax reform act that was signed in December is going to very definitely have a stimulative effect in that it's going to do two things. It reduces the tax rate on corporations so they will be able to have more resources to invest as well as extend their businesses. But in terms of interest rate impact, probably one of the less talked about stories is the amount, and it's measured in hundreds of billions of dollars, that's held by U.S. corporations offshore that will be repatriating to the U.S.